and thank you for joining us to discuss UGE International's first quarter of fiscal 22 financial results for the period ending March 31st, 2022. On the call today, we have UGE CEO Nick Blitterswyk and UGE CFO Stephanie Bird. During the call, all participants are in a listen-only mode. Following the presentation, we will conduct a question and answer session. Selected investor questions via email, but you can also submit your questions through the Q&A tab in the web portal at any time, and management will answer them following their prepared remarks. Next slide, please. Before management discusses the results, I'd like to remind everyone that certain statements in this call may be forward-looking in nature. These include statements involving known and unknown risks, uncertainties, and other factors that could cause actual results to differ materially from those expressed or implied in our forward-looking statements. For caveats about forward-looking statements and risk factors, please see our MD&A for the quarter ended March 31st, 2022, which can be found on our website, on our company profile at sedar.com, and on the company's website. I will now pass the call over to UGE CFO Stephanie Bird. Stephanie?
Good morning and welcome everyone to the call. I'm Stephanie Bird, CFO of UGE International, and I'm joined today by our CEO, Nick Blitterswyk. For today's webinar covering Q1 2022 results, Nick will begin by summarizing our key business highlights for the quarter. Next, I will run through the Q1 2022 financial results. From there, Nick will provide some concluding remarks with a look towards the future before we take questions, then wrap up the webinar. As a reminder, you can submit a question through the portal on the left-hand side of your screen, and we will run through them after our prepared remarks. As always, our goal is to be mindful of your time and keep this webinar concise and to the point. We will be speaking relatively high level and focusing on the areas that we feel are most important to understanding our business and financial results. Our website address is listed here as well, where you can download our full financials. We would also like to remind our listeners that we report in US dollars, so the results in this webinar are represented in US dollars unless we state otherwise. So with that, let's start by talking about our key business results in the fourth quarter. And not in the fourth quarter, in the first quarter. Over to you, Nick.
Thanks, Stephanie. As Stephanie mentioned, I will start off by talking about our project development work and other business updates. On this slide, you see the overall project development table as of March 31st, 2022, which you can find in our MD&A. As most of you have already known, the first quarter of this year saw our project backlog decline for the first time in recent memory. This was primarily attributable to the retroactive changes in Maine, which decreased the maximum size of projects for the state's community solar program from 5 megawatt AC to 2 megawatt AC. Although we had filed good cause exemption requests in hopes of maintaining affected projects' original capacity, and the utility had publicly supported 5 of our 6 requests, in late March, the Public Utilities Commission denied our request, which was the primary reason for the decline. The effect was to decrease our total project in development to 334 megawatts. And as you can see on the next slide, it decreased our backlog to 144 megawatts. The decline is attributable to the following factors. First, we lost a total of 17.8 megawatts DC from the change in Maine, and 5.4 megawatts because an earlier stage project was deemed to have insurmountable permitting challenges. We decreased 5.2 megawatts primarily because of a shift in our strategy in the Philippines market, but offsetting these losses were 16.3 megawatts of new project additions and 1.4 megawatts of increased sizings from existing backlog projects. Nevertheless, our team remained focused, and we're excited to be sharing with you today the growth we are experiencing so far in Q2. As of yesterday afternoon, when we filed our Q1 financials, our backlog had grown to 173 megawatts, which translates to a 29 megawatt increase so far in Q2. This growth comes from several sources, including a few notable ones. First, our progress in Massachusetts continues to impress, as several more of those projects in that state reached stage 3.1. Second, we signed a term sheet to acquire 2 rooftop projects in Arizona, which is an additional growth channel we look to expand going forward. And third, we recently signed our first project in Delaware, another robust community solar state, and our first project in that market. As you can see, we are confident that Q1 was a blip, and we remain on track for another impressive year of backlog growth. We wanted to provide one additional visual this quarter. Each quarter, we publish a supplemental disclosure file, which can be found on our website's investor section. The file lists the projects in our backlog, along with key financial metrics and forecasted milestone dates. Starting with this quarter, we plan to provide a graphical representation of this data as we work towards our medium-term goal of 100 megawatts of operating assets. This chart shows the number of megawatts we are forecasting to hit NTP in each quarter, as well as the number of megawatts we are forecasting to hit COD in each quarter. The dark gray line shows the cumulative megawatts forecasted at each date and is as of this quarter's release, whereas the light gray line is as of last quarter's release, which in this case was just 1 month ago. A few notes on this chart. First, this forecast is for only our backlog projects. It does not include any assumptions for other projects we have in development, in our pipeline, or that we will secure in the future. Or, put another way, we will continue to win new business and expect to add to these figures. Second, a sharp eye will notice that as of now, our backlog is forecasted to surpass 100 megawatts of operational projects in Q1 of 2025. Actually, it's forecasting to blow through that figure in that quarter. We will look to bring in some of those dates and add additional projects to meet or exceed our 2024 goal of surpassing 100 megawatts of operating assets. Lastly, we'll mention that project development is inherently variable, and one should expect these dates to move around as projects mature, but we look forward to sharing our progress towards our goals with you in future quarters as well. On my last slide, before turning things back over to Stephanie, we wanted to highlight a few other important updates. First, we know that it is important for us to grow our operating portfolio and to have more of our backlog reach construction. We currently have 1.5 megawatts of projects in very late stages of construction across 3 sites. One of the sites is expected to reach commercial operation by the end of this week, while the other 2 are projected to be operating sometime in June. Together, this will more than double our operating portfolio. These projects are also our first to include OffTake agreements with T-Mobile and Bloomberg, which we are excited to bring to fruition. Second, we are close to NTP on 5 sites in Maine. The first will officially reach NTP in June. In fact, we have already ordered some of the equipment for this project. The next 2 are not far behind, and we expect to receive final utility sign-off in July, which will set those projects up for NTP soon thereafter. The 4th and 5th sites are also expected to follow soon thereafter. One can see from our supplemental disclosure file and the graph on the last slide that the main sites are not the only ones we are looking to start on this year, as we actually forecast more than 20 megawatts to reach NTP by the end of the year. Keeping in mind that we currently have an operating portfolio of 1.4 megawatts, one can see that this portfolio will scale rapidly in the next couple of years. Next, I wanted to touch on supply chains and especially the trade dispute in the US. As we talked about in our year-end webinar last month, the most notable supply chain consideration right now is the Department of Commerce's investigation into imports of solar panels from 4 Southeast Asian countries, which collectively represent somewhere in the range of 85% of US solar panel imports. Because the tariffs, if implemented, would be retroactive, it has very significantly dented supply of panels into the US and will continue to do so until it is resolved. In the last month, the only thing that has changed is that the political pressure on the Department of Commerce and the Biden administration to resolve this has become very intense. Gina Raimondo, the US Commerce Secretary, has sought to ease concerns, stressing that her department will work to reach a quick resolution and that any tariffs, if implemented, would be more minor than many feared. That said, it is yet to fully ease concerns, and a resolution is paramount to growth in the US solar industry. As it relates to UGE, we have actually been able to secure reasonably priced panels in the past month, both for our first main site as well as an EPC project, which is outside of our project development backlog. The utility solar sector is getting hit hardest by this probe, as margins are tighter in that sector, but it remains tight supply for us as well. Going forward, we expect a favorable resolution no later than sometime this summer, and in the meantime, we'll continue to manage panel procurement closely. As of now, we don't expect that this probe will affect our late 2022 NTPs. Though a very faint silver lining, these challenges may actually ease some of the other supply chain constraints in our industry, given that solar installations have slowed down across the industry, making other equipment more readily available. Lastly, I want to touch on the project development green bond that we closed in April. As our portfolio continues to grow, the collateral that we have continues to grow as well, which opens up avenues such as our green bond product as an attractive, non-dilutive source of capital. It also proves the value of being a public company, as we believe it to be an attractive source of capital versus what our private sector solar developer competitors can achieve. We know this firsthand from the experience we went through in Q1, when we were considering a debt product. We really see the April Green Bond as a test case for future scaling of this product and believe the product fills a void in the market. We had additional demand left over after completing the April Green Bond and look forward to completing future issuances in the not too distant future. And with that, I will now turn it back over to Stephanie to summarize our Q1 2022 financial results, and then I'll return for some concluding remarks before taking your questions.
Thank you, Nick, and thank you for joining us today. I'm going to review a few key items from our Q1 2022 financial results. Looking at this slide, I'd like to thank a couple of eagle-eyed parties out there, as there's a correction to be made to our energy generation revenue, kilowatt hours. The corresponding revenue is correct. Energy generation in the US rose from 103,342 kilowatts to 173,318 kilowatts versus the 140,206 kilowatts reported that you see there. This is as a result of the increase in UGE's energy generating assets. The generation translated into 44,000 of revenue with an 85% margin versus 28,000 of revenue and an 80% margin in the prior year. Revenue from client-financed EPC agreements was 178,000, which marks a decline from 370,000 in the prior year as this line of business becomes less of a focus. Margins have improved as a result of change orders and the result of some recapture of costs in the Philippines. 41% margins are not expected to continue with whatever opportunistic EPC projects we accept. Consulting and engineering services revenue was 142,000 versus 26,000 in the prior year, with gross margins improving from the negative side of the equation to 41% in Q1 2022. We're very happy with the results of this business unit after improving its management bench strength and look forward to continued growth from the business line. The business unit booked almost $600,000 worth of new business in the first quarter alone, demonstrating that further growth is expected. Operating expenses for Q1 2022 were $1.6 million, a 37% increase versus Q1 2021. The increase was due to the increased employee and contractor headcount from 40 at the end of Q1 2021 to 47 in this past period. Our net loss, adjusted net loss, and adjusted loss before interest, taxes, and depreciation increased $488,000, $420,000, and $391,000 respectively when comparing the two quarters. The predominant reasons for these differences are the investments we are making to scale our team and portfolio ahead of the projects reaching commercial operation. As a reminder, we are in the process of transitioning from a one-time revenue model to a recurring revenue model, and losses are expected until the company's self-finance portfolio reaches a larger scale of project deployments and operational projects. While this transition occurs, developing and building projects creates positive cash flow through the retention of our developer fee. This will become more noticeable as our deployments scale up. Moving to the next slide, let's take a look at our financial position. As of March 31st, 2022, UGE had $328,000 of cash and working capital deficit of $1.9 million. On April 8th, 2022, we closed a $2.9 million green bond, bringing the working capital back to a positive balance. Additionally, our cash used in operations for Q1 was just $709,000, and although it is influenced by capital versus expense treatment for some development costs, this is a level we are focused on maintaining. With respect to our cash balance, we are earning cash from a small number of client-financed EPC projects, as well as our core continuing cash sources of developer fees, engineering services, and operating solar facilities. These cash flows are not yet at the scale to have positive net cash results, so as we continue to scale up our development efforts and the backlog matures to yield more projects in deployment, cash inflows from the developer fees in particular will provide us with improved stability in our cash balance. Our balance sheet has been growing as projects progress through our backlog. Of note for this quarter is the increase in construction in progress together with its associated project debt as we move towards energization of a further 1.5 megawatts of projects in Q2. Additionally, there was an increase in capitalized project development costs, which is an indication of the progression of our projects through the backlog towards construction. The increase in the ROU assets and their associated lease liabilities, as well as accrued liabilities for the related commissions, saw some increase in what is usually a slower first quarter. Site securement has picked up in Q2, and it is expected that our June results will show more of a quarter-over-quarter increase than what was experienced in Q1. Operating debt increased $454,000, primarily as a result of a final COVID-related advance. The debt balance for Q2 will be impacted by the aforementioned $2.9 million green bond. That concludes my prepared remarks, and I will now turn it back to Nick.
Stephanie. As you can see, we continue to make solid progress towards our goals. Our operating portfolio will double in the coming weeks as new projects come online, and many projects are expected to reach NTP throughout the year, which will see our portfolio grow much further, especially in 2023. With this growth, we are in a great position to exceed our 2024 goal of having 100 megawatts of operating assets as well. As we have said before, we see 100 megawatts of operating assets as the tip of the iceberg for this business and have much larger long-term goals. With that, we'll wrap up the prepared remarks by pointing you to where you can find more information. As mentioned earlier, our website is regularly updated and contains all of our financial filings, supplemental disclosures, and other updates. You can also find financial filings on SEDAR. You can also visit Sophic Capital's website for additional information and follow us on Twitter to get links to announcements and other media. Thanks again for tuning in today. Marcel, back to you.
Thank you, Nick. We've collected the questions investors have submitted since issuing the financial results this morning, and we've also collected the questions submitted through the webinar's Q&A tab. We'd like to thank all participants for your questions. Our first question comes from Nick Boychuk at Cormark. Nick, please comment and provide more details on the T-Mobile/Bloomberg projects reaching operation this year, along with color on future growth prospects. And how many of those projects are currently recorded in the backlog?
So in Bloomberg and T-Mobile's case, those are both energy off-takers. So just as a clarification to anyone who's not sure, they buy the energy from our systems and they aren't the real estate where the systems are installed. So those three sites that we're just wrapping up right now, those are a combination of T-Mobile and Bloomberg sites. Now our team is very actively looking for additional sites, and we have some in our backlog and in our pipeline that will have T-Mobile and Bloomberg offtake. Now those ones are all within what's called Con Edison territory, so like New York City and surrounding areas in downstate New York. We did mention 1 month ago on our year-end webinar that we have expanded the T-Mobile relationship to include Massachusetts as well. So those are sites that will be built, frankly, a couple of years out from now. But yeah, so I think we continue to expand the types of projects that'll be a good fit for them. I know actually just this morning, actually, I was told by our development team that there's another project we're expecting to have within Con Ed territory that wouldn't be in the pipeline yet, but that we hope to add to the backlog relatively soon. So hopefully that helps there.
And Nick, what are you seeing regarding private market valuations? If you're to look at the pipeline of late-stage assets, what rough percentage would fall in the $2 to $3 per watt range we're seeing in recent transactions? What are the rough valuations of acquired mid-earlier stage development assets?
So Marcel, I'm going to take the first part of that question, and then the last part I might let you rephrase after because I wasn't sure if I understood it. But in terms of valuations, maybe a couple of reference points. So number one is that as projects are financed, especially the tax equity component, third-party appraisals, we get third-party appraisals done on those projects. It's more or less necessary as part of the tax equity arrangement. And so as a result of that, these three projects that are just coming to completion have had their appraisals. In those cases, those have been in the high twos, so more than we typically would have showed in our backlog table. And then more anecdotally, there has been a lot of activity out there in the market, and feel that we're being conservative in terms of the values that we show on our backlog and our backlog table. So very robust market out there for sure. Now, Marcel, I know there was a second part of the question, which if I can just get you to rephrase or ask again and let me know if I missed anything for the first part.
Yeah, so the question was, what are the rough valuations of acquiring mid-earlier stage development assets?
Yeah, so turning the tables, that conversation we were just having is mostly for projects that are operational or soon to be operational. We've mentioned over the last couple of months that we had signed a term sheet to acquire a couple assets, and that's a channel that we look to expand over time. Now, in certainly most cases, the primary goal there is to acquire projects that haven't been constructed yet. So they're in the sort of later stages of development, and we can come in, use our platform, use our expertise to bring those projects to operation, get that lift, use our expertise to finance those projects and so on. The IRRs that we're seeing right there on those types of opportunities are in the mid to high teens levered IRR, generally speaking. So we see that as a quite attractive, accretive opportunity for us too. As our portfolio scales, if you triangulate versus the renewable IPPs and so on that are out there, they're typically being valued at implied discount rates in the mid single digits type of area. So for us to be able to attract mid to high teens in terms of levered IRRs on some of the opportunities we're looking to add to our portfolio, we see that as being quite a accretive opportunity for additional growth.
Okay, and one more from Nick Boychuk from Cormark. Can you provide some commentary on your new market in Delaware? What's the size of the opportunity? How the project was sourced, future demand expected?
Yeah, so that project we added is approximately a 4 megawatt project. That state has a pretty robust community solar market. It's one that we had been looking to get into over the last couple of quarters here. It's of course right next to Maryland and close to some of the other states that we're in. So we see that as being another good driver of growth going forward, kind of in line with Maryland, for example, which we added a few projects in our backlog last year. So we're excited to break the seal on that and look to further expand that going forward. In terms of how that came about, we have a talented team of originators and also different software and so on that we use to identify opportunities. I believe that specific opportunity was brought forward by one of our originators in Pennsylvania, which isn't far from Delaware, and that's the state that he's been targeting of late.
Our next questions come from Devin Schilling from PI. What risks do you see that may prevent you from reaching the 100 megawatt of operating assets by the end of 2024? How should we view the pace of project development ramping up in order to meet this goal?
Yeah, I think from our perspective, taking a step back, right? I think it's important to remember that as a company, we have over 500 megawatts of total experience. We shifted our business model a couple of years ago to holding on to our own assets, and so from a financial statements perspective, that portfolio is just starting to grow, but it's not like we're a new company. We have a lot of experience working these projects through the development, the EPC of them, the engineering of them, and the financing of them. So that risk question, for us, it's really a matter of time. 100 megawatts is significant versus how large we are now, but we actually see as, we call it base camp internally. That's sort of like our entry into a more material size of renewable IPP. So for us, it's really a matter of timing and us working through that. So, I don't have the chart up in front of us right now, but I think right now we're forecasting Q1 of 2025 to be somewhere in the range of 150 or so megawatts. So there's a large number of projects that are in that sort of time scale of late 24 into early 25. Like I said in the prepared remarks, we'll look to bring in some of those timeframes, but then also add additional projects over time. For example, that Delaware project we just touched on, that project we just secured very recently, and yet that's a project we're expecting to be at NTP on early to midsummer of 23, and certainly operational in early 24. So on that basis, you can see that we still have plenty of opportunity to add additional projects to meet that goal.
What does the opportunity set look like regarding acquiring more operating solar assets? Should we anticipate greater emphasis on growth in this area?
Yeah, I think I'll say that we added we touched on this in our webinar 1 month ago, that we had added someone named Shay as a director of origination in our US origination team, and we had some opportunities before that, but since he's come on board, it's been kind of a question about keeping up with the level of opportunities that we're receiving that fit our profile. And so I won't put a number on it quite yet, but and it's I think I won't put a number on it yet. First and foremost, we are a greenfield developer of our own projects, and so we expect that to be the biggest driver of growth. However, we do expect this to be a material second branch of our growth going forward.
Our next question comes from Jeff Cowell, private investor. You have mentioned in the past that a third-party valuation is required to satisfy tax equity. When you reference the value of as of yet built projects to be around $2 per watt, Do these third-party reports reflect that, and can you share those?
Yeah, that's a good question. I touched on this partly in a prior question, but just to elaborate a bit further, what I think we'll plan to do is these three projects that are just reaching conclusion here. As those are concluded, we will provide a summary of these types of figures, including what the third-party valuation was. So of course, I don't think this was the question, but the report itself is something is confidential, but the numbers from it in terms of what the third-party valuations are stating is certainly something that we can and will share going forward.
Okay, this one came from email. At your share price and the project value that will be unlocked in the future, has anyone expressed interest on acquiring the company?
Yeah, a bit of an interesting question. I'd say that anybody watching the stock knows that the share price has come off a fair bit since April 1st, although it's been rebounding lately. And I will say that in the last several weeks, we have seen we have been reached out by some parties who are asking if we'd be interested in that, seeing it as a quite attractive valuation for a company of our size and scale. So our goal and our focus is to grow, reach our potential. We think that there's a ton of value that we're building within the business, but to answer more simply, yes, we have had reach outs with indicative numbers shared with us recently.
The next questions come from Alistair D'Souza. In today's newsletter, you mentioned that you have 20 megawatts of NTPs that are expected by end of year. Does that mean that these projects are expected to be operational by the end of the year? Will this get you to break even cash flow, if so?
Yeah, so there's a few parts to that. And I think if I can manage technically here, let me just flip back to that slide earlier. So this is that slide from our supplemental disclosure document, which can be found on our website. So NTPs versus CODs, now it does vary by project, but it is a few quarters from the time that we hit NTP until projects are operational. So an NTP in late 2024 does not mean the project will be operational in Q4. And you can actually track here in terms of when the light green bars are NTPs, the dark green bars are CODs. So hopefully that helps a great deal. And I know people are seeing this chart for the first time, so there could be follow-up questions and happy to field those. The second part of it, though, is that in between NTP and COD, now this is when we're funding the project, incurring the CapEx, but also bringing in the project funding. And that is also when we start to earn our developer fee. Each project can be a little bit different, but that is a cash flow positive endeavor for us. And so as those volumes ramp up, that's really when our cash flow our burn will decrease and turn positive as those deployments ramp up. So 2023, as you can see with those columns ramping up, is when we expect to cross that threshold.
Okay, and a couple of questions on a little bit more color with regards to your supply chain. Do you have 20 megawatts of solar panels in your possession today to complete the installs, or is it dependent upon the solar investigation into the Asian manufacturers? And what percentage of your solar panels come from Asia versus local manufacturing?
Again, multi-parts, Marcel, so remind me if I miss any of them. But in terms of do we have panels in possession, ourselves, like every other developer that I know, will order equipment for specific projects. And so we don't hold inventory, and holding inventory has been frankly seen as a bigger risk than it's been worth over the history of solar development. So we'll order those as we go. Now, as mentioned, in the last few weeks, we did order panels for a project that will be EPC revenue in New Jersey. And that was, I forget the exact kilowatts, but 800 and something, I believe. And then also our first main site, which is about a megawatt. So there are panels that can be bought out there. I should say, like, let's say that somebody did have, had already bought panels, but hadn't received them yet, which might be a common thing in the industry. And then this investigation started, that will still disrupt them. Like, this is a pretty even playing field in the sense that imports generally, whether those panels have been bought before or not, are restricted based on this investigation. Now, in terms of the question about local manufacturing versus global manufacturing, so the tier one companies in the industry, the top companies that manufacture in this space, they typically, just generally speaking, have manufacturing capacities of like 20, 30, 50 gigawatts per year. Of course, times that by 1,000 to get to megawatts. The company that is a domestic manufacturer that filed this petition that disrupted the whole industry, they're estimated to manufacture about 10 megawatts per year. So less than 1/1000th of a typical manufacturer in this space. The only like kind of semi-material increase in manufacturing that I know in the US is a company that's hoping to have 400 megawatts available by sometime this summer. So not just for UGE, but for the entire industry, this is a global supply chain. 85, give or take, percent of solar panels used in the US solar industry are imported from these 4 Southeast Asian countries. So it is far reaching. It is also why, frankly, you see so much political blowback based on this investigation. There's a lot of articles out there. Everybody's using their PR channels to put pressure on the Department of Commerce to get a quick resolution. I'd be remiss not to say there was an investigation last year, similar type of thing, brought forward by the same manufacturer and a couple others, that was thrown out. So we're certainly hoping that the same thing happens this year as well, but it's a kind of self-imposed speed bump in the meantime.
Yeah, you covered the questions there. So the next set of questions come from Gary Renault. How long are offtake agreements, generally speaking?
Yeah, so it does vary. Like in the case of the T-Mobile agreement, that's 25 years. So like a corporate offtake, like the 2 PPAs that we have operating in New Jersey, I believe those are both 25 years. The term sheets for the rooftop deals that we'd be acquiring, those ones I also believe are 25 years. So corporate offtake typically has that longer term offtake agreement, and then for but within community solar, you will quite often get much shorter time periods. Like, for example, people move, right? And so a common arrangement will be that it's a 25-year agreement, but if you move, you get a free out. But from our perspective, and from the industry's perspective, that's a fine arrangement because the way the community solar credits work is really they can be sold to anybody within that same utility zone. And so there's obviously plenty of people that'll take a 10% discount on their energy bill.
And related to that, how are prices adjusted to reflect possible future inflation?
So some of those corporate offtakes will be a fixed, it'll be this many cents per kilowatt hour increasing by this percentage per year type of an arrangement. The community solar arrangements that we talked about, though, they will typically float with utility rates. So that was a really big boost for our revenue profile on our projects this year because energy rates have increased so much. I think like 30 and 40% in Maine and New York respectively this year, if I have my numbers right. So that's quite a boost for us in terms of our revenue profile. I know I read an analyst report just earlier this week that was talking about expectations that utility rates will increase by an average of 5% per year going forward. That's significantly higher than what we model out in our models and would be a gain for us as well. So on all those bases, higher inflation actually really helps our revenue profile.
Okay, we have a question from another investor here. How are you looking at operating costs? Are you set in terms of staff or other operational needs for the near term, or do you see that growing?
Yeah, we are largely set. Now as we scale, there will be iterative tweaks and stuff that we make as we scale. We're obviously going to be building a lot more projects going forward. But last year and into the beginning of this year was really about finishing out, sort of like building out the framework and so on to do what we do. Like for example, our capital side of our business, Brent, who's the managing director of that business, started full-time beginning of January. He had been a consultant ramping up in Q4 of last year. So there's things like that we were getting set into really Q1 of this year. But the overall framework of the company is something we feel really good about. So it's much more marginal tweaks at this point in time.
And we have a follow-up question from Jeff Kyle. On page 20 of your updated investor deck, you state the current project value at $274 million. Can you walk us through how that was calculated?
Yeah, so I don't have page 20 in front of me, of course, but to talk about that at a high level, project value. So each of these projects has a financial model, right, that we build and we'll tweak as those projects come to fruition. And so that's based, of course, on the revenue and the cost to operate that project and so on and so forth. We'll apply a discount rate to that project and we come up with that valuation that's shown there. So, I think I definitely feel we're fairly conservative versus many of the things that you see out there in the market. I have to admit that off the top of my head, I'm forgetting if that's 8% or a 10% discount rate. I don't have page 20 in front of me right now, but I bring this up because, as I mentioned earlier, typical renewable IPPs are trading at a mid-single-digit % type of implied discount rate. I know Sunrun, the largest residential solar company, I believe they use 6% in their visualizations of their the value of their book as well. I'll also say that we don't we often hold options to extend our projects. Right now, we don't value those. We're really focused just on the base the base time frame of these projects. So I think there's a lot of conservatism in there, but that's how it's calculated.
And one more question from email. Can you please provide a status of the main projects and how we will see those come online?
Yeah, I'll go into a little bit more detail. So number one, of course, that's the blew up so quickly. It grew so quickly over the last couple of years that that certainly the state had some trouble keeping up with the time frames, and we've experienced that, of course. But as of right now, the first one the first one is right around NTP right now. We've actually already started ordering equipment for it. I think we'll officially declare that as NTP in just a couple of weeks here. But that one is quite near term. I know that there was it's in Norway, Maine. I know there was an article out there about that project a few weeks ago. And then the next two, so it's interconnection is the high pole in the tent for most of these projects as we wait to build them. We have received interconnection agreement on that. There's a thing called a cluster study that allocates any sort of transmission level upgrades that need to happen. That's done. We've verbally been told that at the there's a monthly meeting, and that at the July meeting we'll receive our official go ahead on those two projects. So those ones we've already anecdotally been told that's the timing for the last approval on the interconnection side, and then the next two are not very far behind that. They're on a very similar path, and similarly, we're close to the utilities and so on to understand the process. So those are all coming fairly quickly now. I will say that we've been talking about 5 main sites for a while. There's actually a 6th that's also expected to be within 2022 as well. That's it must be a couple months after that.
Someone is at the side door.
Okay, there are no further questions. I'll now pass the call back to management for closing remarks.
That's good. Thanks, Marcel. And presumably people can hear that there's someone at my side door, so I'll get that. But I just want to thank everyone again for tuning in today. I really appreciate it. And we're always here for questions, and I know the good team at Software Capital is as well. So thank you for your support, and look forward to continuing to show our progress going forward here.
This concludes UGE International's Q1 2022 conference call. Thank you for joining us, and enjoy the rest of your day.